This video is going to feature factors that affect foreign exchange rates. How you will notice this is if you go into your local travel agent and you say to them, I'm going to America next month, I need to sell some pounds and buy some dollars. They might say to you, okay, every dollar we sell you is going to cost you 90 pence. Now that same travel agent a year ago may have been selling their dollars for £1. So in that time period, basically what's happened is the Great British pound has appreciated against the dollar. So it now takes less pounds to buy that same dollar. So why does this happen? Because currencies are constantly being devalued and valued against each other. The main focal points that affect this exchange rate is supply and demand. So we need to focus on a few things that affect this, mainly on the demand side. One of the biggest players in the supply and demand chain is international trade and also investment. So we're going to focus on international trade to start off with a nice simple example, just for simplicity. If Japanese businessmen worked out that Xbox games were cheaper in South Korea, they could have a business opportunity by buying those, importing them to Japan and then selling them in their shop for a profit. Now what would happen over time if lots of Japanese businessmen kept doing this is they would need to do a certain thing with the two currencies. Because each country has a different currency, you have to sell your own currency to buy the other currency just to buy a product from that country and then import it again. If this keeps happening, there would be an imbalance in trade, and this is something that economists focus on when valuing exchange rates. So for Japanese businesses, in order to buy these games that are cheap in South Korea, what they need to do is sell their Japanese yen at market in exchange for South Korean won. They can then buy the games from the South Korean businesses, import them into Japan and then sell them in exchange for Japanese yen once again. And they make a profit because obviously the game is cheaper to buy in South Korea than it is to sell in Japan. If, for argument's sake, every business owner in Japan was at it, then what would eventually happen is there'd be a lot more people selling Japanese yen in order to buy South Korean won. So the exchange rate would change. The Japanese yen would be basically being sold, so its value would decrease, and what they're selling yen to buy is South Korean won, so the demand for that would increase, which would push the price up. So basically what would happen is the two currencies would adjust, and it would mean that it's no longer cheap for Japanese businesses in order to buy that game from South Korea. So the exchange rate has been affected because of an indifference in the supply and demand of these two currencies. What basically this does is if you have a country such as Great Britain with their pounds, which is quite strong against some of the other countries such as the Indian rupee, it makes imports. So anything you buy from other countries is quite cheap. However, them poorer countries, it makes it very expensive for them to buy from you. And this is why it's so important to understand the exchange rates when it comes to international trade. To really show and demonstrate how important this is, we can use the example of the Indian government and what they did with the tax on gold imports. India is the biggest consumer in the world on gold because it's very important to their culture with wedding presents, etc. So India imports nearly all of its gold bullion and gold needs through other countries. So what we can do is we can use the example of Russia, because Russia is a massive exporter of gold. For Indians to be able to buy gold from Russia, what they need to do is obviously Russian companies will bring the gold to India. They will then sell it in exchange for rupees. The Russian companies will then change their rupees or sell the rupees that they've just got at market in order to buy back into their own currency where they can then spend and pay their workers in Russia. What this will do is it will be a massive sell-off in rupees, which will reduce the value of the Indian rupee and increase it against the Russian currency. However, this doesn't always work out this way because governments can actually intervene to keep currencies cheap. Remember we said about South Korea. So if a lot of South Korea businesses are making profits exporting export games to Japan, what it will do is it will create more jobs in South Korea. And this is exactly what we saw in China. Now, we're not going to go on about this right now because we have a separate article on our website for how China manipulated its currency in order to make sure that it was always cheap for big consumers such as the USA to buy from China. So it artificially kept its currency quite low. Other factors that affect exchange rates, as I said at the beginning of the video, is investment opportunities. But before we get to that, there is a link below this video if you're watching it on YouTube that will take you to an article on our website that will talk through very similar and also more diversified points on what affects exchange rates. A little teaser would be the price of oil. If that was to suddenly increase, what effect would that have on places like Canada, which are big oil exporters? What effect would it have on the Canadian dollar? So if we look at investment opportunities abroad, because that will have a big influence on exchange rates, if there was a massive global financial crisis, what a lot of countries might do is they might want to what's called a flight to quality. So countries such as the USA and Switzerland might find a lot of foreign investors are selling their currencies to buy US dollars or Switzerland denominated assets in order to see a safer than average investment. So that would affect the exchange rates because they're selling, perhaps in Italy, they're selling their euros to buy US dollars, which will cause a discrepancy in the exchange rates. Also, you may have seen in the news that when jobless figures come out in America and they're better than expected, the dollar will rally. Basically, there are a lot of investors and investment hedge funds, etc., around the world that look for these key reports. If they are more bullish than expected, then what might happen is they might want to sell their currency, buy dollars in order to invest that in the US stock market. One final thing we're going to talk through just to leave you as before you click on the link below the video is sometimes during countries' financial crisis, what they will do is they will put a ban on short selling of their bank shares. So basically, when the bank shares are declining, the government will say, we are now banning for X amount of time anyone short selling, which will exacerbate a down move in bank shares. This gives investment opportunities to other countries because they know there is a ban on short selling, so potentially them shares could increase. So what we might want to do is we might want to sell our currency to buy the other currency so that we can buy shares in that country. So that pretty much concludes the video. Hope that you've learned quite a bit, and don't forget to click on the link below this video to expand your knowledge in this subject. Thank you for your time.